What if the biggest threat to an economy isn't inflation, but the fear of what happens when growth disappears? Because right now, Russia is making a move that goes directly against everything you'd expect from basic economics. And it tells us a lot more about the real state of its economy than any headline number ever could. Welcome back. Today we're diving into what's really happening inside the Russian economy, and more importantly, why the central bank just made a decision that has a lot of economists raising their eyebrows. Now, before we get into it, if you're new here, consider subscribing. It helps the channel grow, and more importantly, it keeps you ahead of stories like this that most people don't fully understand until it's too late. Let's start with the core problem Russia has been dealing with since the war in Ukraine began: inflation. Not just slightly elevated prices, but persistent, unstable inflation that refuses to settle down.
Officially, the Bank of Russia targets 4% inflation. That might sound high if you're used to the US or UK, where 2% is considered normal, but Russia operates under different conditions. Its economy is structurally more volatile, more exposed to shocks, and less predictable. So the central bank accepts a higher normal level, but even by those standards, things have been running too hot.
If we rewind to March 2025, inflation hit 10.3%, the highest level in 2 years. That's not just above target, that's more than double it. Then, for a moment, it looked like things were stabilizing. By December, inflation had dropped to 5.6%, still elevated but clearly moving in the right direction. And then, it stalled. January came in at 6%, February followed at 5.9%. So instead of continuing downward, inflation flattened out at a level that's still roughly 50% higher than the central bank's target. Now, normally the playbook here is simple. Inflation too high? You raise interest rates, make borrowing more expensive, slow down spending, cool off demand, and eventually prices stabilize. We've seen this exact strategy play out across the US, Europe, and most major economies over the last few years. But Russia? Russia is doing the opposite. Instead of tightening, it's easing.
In March, the Bank of Russia cut interest rates again, bringing them down to 15%. And that raises a very obvious question. Why would you lower rates when inflation is still clearly above your target? To understand that, you have to look at how we got here. Right after the invasion of Ukraine, the Russian financial system was under extreme pressure. The central bank reacted aggressively, hiking interest rates to 20% almost overnight. That was emergency mode. The goal was to stabilize the ruble, prevent capital flight, and stop panic from spreading through the system.
And it worked, at least in the short term. But 20% interest rates aren't sustainable. So by the end of 2022, rates were brought back down to around 7.5%. That gave the economy breathing room, but it also came with a cost. Cheaper borrowing led to more spending. More spending drove demand, and demand pushed prices back up. Inflation started rising again. So in response, the central bank slammed the brakes. Throughout 2023 and into 2024, rates were pushed all the way up to 21%, one of the highest levels anywhere in the world. That was a clear signal. Inflation control was the top priority, but over the past year, something has changed. Rates have been steadily coming down, and this latest cut confirms that the strategy has shifted. So what changed? Growth. Because while inflation remains a problem, the Russian economy is now losing momentum, and losing it fast. On paper, things look strong in 2023 and 2024.
GDP growth came in above 4% in both years. That sounds impressive, especially given the geopolitical situation, but here's the catch. That growth wasn't coming from a healthy, balanced economy. It was driven heavily by government spending, especially military spending. Russia essentially restructured itself into a wartime economy. Large parts of the industrial base were redirected towards supporting the war effort. Companies were funded, directed, and in many cases fully dependent on state demand. That kind of growth can look strong, but it's not sustainable. And now we're seeing the aftermath. In 2025, growth dropped sharply to just 1%. That's not a minor slowdown, that's a clear loss of momentum. So now the central bank is facing a difficult choice: fight inflation or support growth, because doing both at the same time is no longer possible. If rates go up, inflation might come down, but the economy risks slowing even further. If rates go down, growth might stabilize, but inflation could flare up again. Right now, Russia has chosen growth. Lower rates mean cheaper loans, more borrowing, more spending, all aimed at keeping the economy moving. But this is where things get risky. Cutting rates while inflation is still elevated is like trying to put out a fire by adding more fuel and hoping it burns out faster. It can work in the short term, but it often creates bigger problems later.
There's also the currency factor. The ruble has been relatively stable, but not because of strong fundamentals. It's heavily managed, with limited external pressure simply because global interaction with it has decreased. That stability is fragile, and lower interest rates increase the risk of further weakening. Then there's the long-term issue of inflation itself. This isn't a new problem for Russia. Elevated inflation has been present for years now, slowly eroding purchasing power, reducing confidence, and making the entire system more unstable. And just as that wasn't enough, there's now an external pressure building, the global situation. The ongoing conflict involving Iran is pushing energy prices higher, oil, gas, transport costs. And while higher oil prices can increase Russia's export revenues, they also raise costs across the economy. Imports get more expensive, supply chains become less efficient,
and those pressures feed directly into domestic inflation. So what we're likely looking at in the coming months is renewed upward pressure on prices, not just globally, but inside Russia specifically, which makes this rate cut even more questionable. Instead of preparing for inflation to rise again, the central bank is effectively taking steps that could accelerate it. Now, you could argue this is a calculated move. Support the economy now, deal with inflation later. But history shows that inflation rarely fixes itself. Once it starts gaining momentum again, it usually requires much more aggressive action to bring it back under control. And that's where the real risk lies. Short-term stability, in exchange for a potentially bigger problem down the road. This decision tells us something important.
It suggests that the pressure inside the Russian economy is stronger than what the surface data shows. Because if things were truly stable, there would be no need to cut rates in this environment. The fact that they are cutting is a signal. Something underneath isn't working. When you combine slowing growth, stubborn inflation, pressure on the currency, and rising global costs, you get a very difficult situation to manage. There are no easy moves left. So where does that leave us? Inflation is still above target, growth is weakening, and the central bank has decided to prioritize keeping the economy moving, even if it means taking on more inflation risk. And with global energy prices rising and supply chains under pressure, that risk is only getting bigger. This is one of those moments where policy decisions today can shape the next several years. And right now, Russia is making a bet.
The question is whether it pays off, or whether it makes the next phase of the problem even harder to control. I'll be keeping a close eye on how this develops, because the next few months could be very telling. If you found this useful or interesting, leave a like, and if you want more breakdowns like this, make sure you're subscribed.